It's Mark Yegge here, wealth architect and lifestyle investor. Let's take your life to the next level. Welcome to the Wealth Architect Podcast. Hey, everybody, it's Mark Yegge. Welcome back to another Wealth Architect Podcast episode. Glad you're here. And today we have a certified financial planner. This is an interesting niche in the market. And this gentleman is a three-time #1 best-selling author and the owner of Lake Growth Financial Services there in Chicago. As the host of Not Your Average Financial Podcast, he shares some of his strategies for investing in real estate, paying for college without going broke, and creating an income in retirement that you will not outlive. He works with people who want to grow their wealth in ways that are safe and predictable, and they want to become their own source of financing and create tax-free income in retirement. Please, let's say hello to Mark Willis. Hello, Mark.
Hey there, Mark. Mark and Mark. We're here together. I'm glad we finally made it. Thanks for having me on the show.
Mark and the funky bunch, like you said,
right?
right?
That's right.
Let's talk some finances. A couple of Mark's brothers talking finances today. So tell me a little bit about what you're doing and how you got started.
My privilege and honor is to get to work with clients on a one-on-one basis. We work with real estate investors, business owners, even some NFL Super Bowl champions. But most people, I'd say the majority of the people I get the privilege of working with just want more financial agency in their life. They want more control, more certainty of success and outcome. They've seen too many times their plans come to failure or ruin, and they have ultimately thrown up their hands and said, I don't want to be the tennis ball just floating down the gutter of my financial life here. I want to take some more certainty and agency in my life and swim upstream if need be, even if it means doing things against the flow, against the so average financial infotainers that are pushing their, whatever, their stocks, bonds, mutual funds, the stuff that you could buy at the financial mall, let's say. And they want to find something that is a little more custom designed and nuanced and bespoke to their solutions. So as a CFP, Certified Financial Planner, I follow that process, but we end up arriving at custom designed solutions, not just, stamp it and print it kind of financial plans that seem to churn out failure more than success. So that's what we have the privilege of doing. I've done this now since 2011. And really before that, I was working for a CPA firm helping her clients with mostly tax prep, but I would overhear the phone calls, Mark, the phone calls of 2008 and 9.
Yeah.
The phone calls like, oh, I'm sorry, Mr. 62-year-old client, but I just lost you half your life savings.
Yeah.
And that kind of devastating conversation I never wanted to be a part of. And I almost got out of the business until we found some strategies that were so different that it made me rethink my overall personal financial approach to life and that of my clients. So that's what helped me and my wife start Lake Growth Financial Services. And now we work with clients in all 50 states, a little over 1,500 clients. It's been our great honor and it's been a lot of fun.
It sounds like fun. It sounds like you like what you're doing as well. That's great. And if you can make a difference. So, that's the thing is we're programmed to hear, put your portfolio in a nice, put your money in a nice portfolio of stocks, bonds, mutual funds, ETFs, and you'll be fine. You'll get your 8%. But I just did a video where I had ChatGPT help me analyze what inflation has actually been over the last 4 or 5 years. And it came up with a minimum. And I think this is a minimum because I didn't weight it that well. But, eggs are up 80%, for example, right? But we don't spend a huge amount of money on eggs, but we do on rent.
Yeah.
And so we came up with an average of about 11.1%. So what most people aren't realizing is if they don't get 11.1%, they are going backwards. They think 2 or 3% that the Fed tells them is the right number. But I can tell you, that if you go out and get a cup of coffee or a martini, it isn't costing $3 or $4 anymore. It's costing a lot more. Hamburger is, anywhere you go now is 10, 12, 15, $15. So that's the baseline is we're not even getting, 11% on our investments. But most financial planners are still talking about, well, we're going to just get you a nice 6 to 8% return because we're going to dollar cost average and we're going to, asset allocate and we're going to do all that stuff. How do you kind of rise above that message and get them to the next level where people can start thinking, look, if I don't beat the Fed, if I don't beat the inflation rate, I'm really going backwards. I'm failing, as to use your word. How do you do
Oh,
that?
yeah, you're exactly right. And for those of us that think that the inflation rate is what the government tells us, it's sort of like asking your child to tell you what they got on their report card without actually looking at their grades. It's not the truth, right? Yeah, you can about double what they tell us from the pulpits, the bully pulpits of the CBO and more. So you're right. There needs to be some solutions. And I'll also uh, double underline and bold and italicize what you already said, that average rates of return are just 100% meaningless. They are a falsity. They are a lie. And the SEC, Securities and Exchange Commission, allow financial advisors like myself, which I don't subscribe to this and I don't do this with my clients, but they are allowed, financial advisors are allowed to advertise average rates of return. And here's the falsity I'm talking about.
How can you do that?
Yeah, no, it's an absolute travesty. I think it's a shame, and I think folks should be in trouble for it. But here's an example for those of your listeners who may not be familiar. So let's say, for example, you had an investment that you put with Summit Financial Advisor, and that financial advisor got you a 100% rate of return in year one. Let's say
Yeah.
you invested 10 grand. Okay, so 10 grand goes in, they give you a 100% rate of return. Now you have what, $20,000, right? So your 10 grand went up to 20 grand in the first year. Let's say in the second year, you have 20 grand and they unfortunately lost you 50% of your money. So from 20 grand, you're back down to your original $10,000. Mark, do you feel any wealthier after 2 years?
Yeah, no, not at
No,
all.
no,
But
you're back where you started, right? And not to mention inflation, like you mentioned. But did you, and for your listeners, please realize that the average rate of return over that experiment was 25%.
yeah,
And I could show you on your account statement, there it is. You got 25% rate of return. Aren't you happy? But the reality is, averages mean nothing. You cannot spend a rate of return at the grocery store. You can only spend money at the grocery store. And so, real returns are what I'm most interested in. What's the compound annual growth rate? What's my internal rate of return? That might be a bit better. But really, I want to see what is the change in value after I've sold such and such investment. How much more money do I have now than what I started with? That's the true litmus test of actual performance. Until then, it's just numbers on a piece of paper or on a digital screen. So,
yeah. Plus further, if you're a financial advisor, right, a financial planner, you got 1,500 clients, for example. They're all different, right?
right. Mm-hmm.
It's one thing to say you have a program that teaches people how to do something and this is what you target. It's another thing to say, here's what I get, because everybody's different. A 35-year-old guy invests differently than a 65-year-old woman. And
Mm-hmm.
so I'm surprised that they allow that to happen. But,
Yeah, and unfortunately, it has devastating impact. So, when you expect that you're going to get, like, the market always gives us whatever, 8%, 10%, so they say,
yeah,
over the last 100 years, 10%, let's say.
yeah.
This is according to third-party research. So this is not just me talking. There's no dog in the fight. Dalbar, which is a research firm out of Boston, regularly puts out the quantitative analysis of investor behavior study. And every year they put out the report. It shocks people because the actual asset allocation investors, that'd be your target date funds in your 401k, your IRA funds, your ETFs, your index funds, all that junk. That's typically giving the real investor over a 30-year period. Are you ready for this? 3.6% per year, real return over a 30-year period before taxes.
I bet if you looked at the how much the other side of the equation, how much the advisors and the 12B1s and the
Yeah.
salespeople were making, it would be more than that,
Oh,
right?
there you go. Yeah. So according to the Department of Labor, a 1% fee on a IRA, for example, or a 401k, a 1% fee over 35 years, which is a typical time horizon for an IRA account to be open. You're going to live with this thing and retire with this thing. It's at least going to be 30 plus years, hopefully. That 1% fee amounts to 28% of your total account value just sucked away like a leech on your back just to fees. So somebody's getting a guaranteed yield off of your IRA, but it's not you.
Yeah. Yeah. It's really amazing what's out there. So it's refreshing to hear somebody with the CFP after their name talk about things like this, because so often we just, we give up our power, right? And so we
Right.
keep our chunk of money because we're working hard and we don't want to have to learn our business, your business, whatever. So we just go, here, do something with it. And those people will put you into a nice portfolio of stocks, bonds, mutual funds, and ETFs. And we have to get away from that. We have to educate people, and we have to have people that have different approaches like you. So let's talk about some of those different approaches. What do you come at? I know that everybody's different, but what do you come to your clients with that's different?
Well, I would just say this, that I think what you and I do provides people with the financial nuance that comes with actually listening to their needs.
Yeah.
So, when I sit down with clients, I don't have a preconceived notion of what will work for them or what the right move is for them. We don't jump to conclusions. That's a game we stopped trying to play when we were kids. So, how do we get that plan in front of us that, first of all, puts the person or individual first rather than the product? We have to fall more in love with our clients than we do with any financial tool or strategy. That said, there's a strategy or two that out there that has been more, I think, prevalent lately, especially because folks are wanting, rather than the improbable attractive outcome, they want the certainty of success. So what I mean by that is, instead of the improbability of an attractive outcome, they want the certainty of success. So I find a lot of people have lost money in the markets. They went through 2008. They went through another market down. Maybe it was a divorce. Maybe it was a disability, some other financial shaking that had taken their money from them. And by the way, according to the Journal of the Medical Association, JAMA, a wealth shock of at least 100 grand will increase your likelihood of a heart attack or other major medical ER visit by upwards of 30%. So that just sort of shows you that wealth and health are directly linked.
Totally.
But anyway, so if folks have had a couple of those shakings, or at least one or two of those shakings, they want that certainty of outcome. They want to know that if I do X, I'm going to get Y every single time. And so, of all things in the financial universe, and again, I studied 450 different financial tools to get my CFP designation. It took me 3.5 years and, a lot of sleepless nights, and my wife's very patient as a result. One of the things that really caught my attention, and I think relates to some of the strategies you offer clients, and we can get to this too, is, of all things, dividend paying whole life insurance. Strangely and boring as it sounds, let me just describe how this works and then how it relates maybe to some of the strategies you recommend. So first and foremost, I can boil it down to 4 quick ideas, and then I want to get your feedback. So first of all, this is not the kind of whole life insurance that, our parents had, or that Dave Ramsey yells about, or whatever. This is modernized for massive accumulation early on. You cut the commissions out of the thing, you cut the insurance out of the insurance costs out of the thing, and it becomes a lot more interesting to me as a financial planner for my clients. So here's what happens.
Let me stop you there. Hey, it's Mark Yegge here to tell you about our cash flow machine trading program that's designed to teach you how to make safe, reliable income. Now, we shoot for 2 to 4% a month of income and growth in your portfolio. And we have courses to teach you how to do this yourself or inside a mastermind community. And the best part of that is it only takes about 20 minutes a week to implement. Now, while 2 to 4% a month doesn't sound like much, I show you exactly how we took my IRA from $111,000 to over $500,000 in just 19 months without huge risk. I'm not telling you this to brag, just to show you that you can do this too. So to learn more about this program, go to cashflowmachine.io. That's cashflowmachine.io, and you can learn more.
Please, yeah.
How do you cut out the commissions and cut out the insurance fees?
It's all in the design. So if the insurance agent or the financial advisor that built it for you was thinking about him or herself first, there's going to be a lot less cash value early on relative to what it would be if it was designed for cash accumulation. Think of it almost like a seesaw. You can either build it for a big death benefit and a small cash value, or a big cash value and a smaller death benefit. So if we can cut the death benefit down by 2/3 from, let's say, $1 million to 300 grand, let's say, death benefit, then your cash value is going to be 6 to 40 times more money in there, just in how we design that. So 6 to 40 times more money is a lot more money, depending on how you design it and everything. So once it's in there, what is that cash value doing? That's the intriguing piece to me as a financial planner. So number one, the cash value every single year is contractually obligated to grow, guaranteed.
Right.
So no matter what you got more money this year than you had last year, guaranteed.
Got it.
That's
Okay.
pretty cool
Yeah.
already. Second, it's tax-free access to the money anytime you want it.
Yep.
Tax-free access to the money anytime you want it is a very rare sentence. It's very hard to say that. It's very hard to say the word guarantee in the financial world. It's also really hard to say tax-free access anytime you want it in the financial world. Those two things alone make this thing a unicorn among unicorns. Third, it is life insurance. So you're going to leave your family automatically more than you've ever saved for them in the product. Can't do that unless I can't think of many other tools that do that either. And then the last one, this one's really interesting. You can access the policy like a bank. It almost becomes a bank for yourself. In fact, we refer to this as bank on yourself designed whole life insurance. So think of it almost like setting up a line of credit for yourself where you can borrow against the cash value that you own, and the policy sets up a repayment that you control. So again, you're not beholden to some financial institution here. You can repay the loan quickly. You can skip a few payments. You can go 20 years and not repay the loan. If you pass away and you never pay off the loan, it's just deducted from your death benefit when you pass away. And while the loan is outstanding, and this is the last thing, and I'll hush after this. Let's say you have a $100,000 cash value and you've borrowed out 80 grand to invest in some real estate or some covered calls or whatever else you might want to invest in. You could borrow against that $100,000, borrow 80 grand out, and the policy will still continue to grow and compound on the full 100,000 bucks, even though you'd borrowed against it 80 grand and put that money to work elsewhere.
On the full 100.
Correct, on the full 100,000, as if you hadn't touched a dime of the money.
Hmm.
So could that be a way to let your money do two things at once? A lot of our clients see that as the pathway past opportunity cost, where everybody has to choose either I invest in stocks or real estate, or either I buy my car or I prepare for retirement, or either I send my kid to college or I save for my own retirement.
Right.
It's not an either or when you've got a tool that has uninterrupted compounding, even when you have liquid access to the money to go invest.
And is that liquid access to the money available day one, or is it available, only after 10 years or something?
Yeah, no, great question. Many insurance companies will restrict your access. If we're calling it bank on yourself designed, I'm using those phrases particularly because there are a lot of insurance contracts out there that don't do what you and I are talking about today. But there's a IP protected, trademark designed style of whole life insurance. We call it bank on yourself designed. And if it's that, then yes, within usually a week or two of the policy getting started, you have cash values in there that you can immediately access. I'll tell you a quick story. There was a guy who had actually, his house was on the same block as the Full House house. Okay. And he wanted to renovate this house to improve the value of the house. So, out in the pretty parts of San Francisco. He had $800,000 in his cash value life insurance policy. He borrowed out most of it to do the renovations. And his policy still continues to pay him the full guaranteed growth and the dividends as if he had never touched the money. And he's got the appreciated value of that property now as well.
So why wouldn't somebody just put money into that and then borrow 100% of it right back out as it continues to grow, and then put that money into something that's growing very quickly as well, like real estate, covered calls, whatever?
Yep, many people do. Now there's some gotchas and considerations. Many people do exactly that though.
Yeah, sure.
So you've got insurance costs, even on well-designed, perfectly efficient whole life insurance that's designed the bank on yourself way, you're still going to have an insurance expense. Because you're buying life insurance, there's going to be some sort of cost. So it's not going to be perfectly efficient in the first few years. Somewhere between 70 and 90% of your dollars going in will be liquid in the first year. So that's not bad, but you are losing some efficiency in the first year. So I always tell folks, sorry, go ahead.
No free lunch.
No free lunch. Yeah, you're buying a death benefit that might be 2 or 3 times as big as your whatever your contributions. So there's going to be some kind of expense to that or liability in case I kick the bucket this year. But I always tell folks, don't do this strategy if all you care about is like immediate return. This should not be a get rich quick scheme. This is a get rich for sure over many years. 3 to 5 years later, it might be growing beyond your contributions. Beyond that, it's just going to continue to show gains for the rest of your life.
Interesting. And so who is a good candidate for this?
What a great question. I'd say somebody who is comfortable with a moderate return for the purposes of their cash side of their portfolio.
Okay.
So again, this is not going to give us the triple digit returns or even the double digit returns that we might get from some of the awesome strategies you might share. But I see it as a both and solution, right? In fact, there's the efficient frontier of our portfolio. That's the old phrase, but think of it like a barbell. On one side of the barbell, you might have a safe or risk-free asset like cash value life insurance. On the other side, you might have, speculative investments of different types, including some of the strategies you might recommend. So when you have money on the safe side of your portfolio, you're able to take more risk on the risk side. And there's a spectrum there, all right? The more you have on the risk-free side, the more fun you can have on the other side. This is known as the barbell strategy. And more people are realizing that if they take some of the money and keep it in a predictable, increasing to grow for you every year bucket, you can take more risk over on the other side of your bucket, especially if one side of the barbell can serve the other side of the barbell and help you grow that, the risk part of your portfolio.
Gotcha. Makes a
Now
lot of sense.
you said who else would it? Maybe it
Yeah,
would
who
not
would
work
be
for
good for
folks. Yeah,
yeah.
it's not going to work if you have literally nothing saved and you're unwilling to save from your cash flow, or you have nothing saved in the bank or somewhere else, IRAs, whatever. It has to come. You have to be the one to fund this thing, otherwise it just won't be able to work. A lot of folks think, well, Mark, I should have done this when I was 22 and now I'm too old. No, generally we can start these policies for folks even until like age 85.
Oh, yeah.
You can be the insured. Yeah. And even if you've had a couple of health issues, like let's say you've had a couple of health issues in the past, you can be the owner of a policy. I had a guy who had quadruple bypass surgery, and so he was himself uninsurable, but he was able to get policy on his wife and his 3 adult children, all of his grandkids. He's the owner of 12 policies. He just happens to be the owner rather than only the insured. And so he controls all the money. He gets to get the dividend statements every year and that sort of thing.
Interesting. Well, that's fascinating. How do people find out more about this and about you and what you do, and how can you help them?
Well, yeah. So we've done a ton of content online. If you like this podcast, you might like Not Your Average Financial Podcast. That's our show. We've got
Yeah.
over 350 episodes as of this recording. One's dropping every Friday. Our YouTube channel has got hundreds of episodes and videos as well, with spreadsheets and more. And, keep an eye out for us. If you'd like to reach out and meet me, then do a 15-minute phone strategy session. The easiest and simplest way to go about that, to meet with me or one of my colleagues, would be to go to kickstartwithmark.com. That's Kickstart with Mark with a K, just like our host here today. Kickstartwithmark.com, and we can have that conversation.
I love it. That's easy to remember too. So that's great. Any final words of wisdom you'd like to leave with our listeners and viewers?
Well, again, just think about what it does when you have a asset like whole life insurance that you can then access to invest in, say, another investment. Doesn't that increase the yield of the investment without any additional risk? And why would you make an investment any other way? In fact, that's what I do. That's what a lot of our clients do. Clearly, we want the expertise of someone like Mark, the other Mark, the real Mark on this show, right? The ordinary Mark on this show, to help you, guide you on which strategies to take and what approaches to make to covered calls and other strategies like them. But why pull from a cash savings account or a brokerage account if you could get something from your whole life policy that would continue to grow and give you an additional middle single digit yield, tax-free yield, in addition to whatever you might find on the market. So that's my parting piece of advice. Think about, how do you overcome what's bigger than inflation? Opportunity cost. Because every time you buy one thing, you're saying no to everything else. But if you could find a way to overcome opportunity cost, I think you've really, swung the smallest hinge that can swing the biggest door.
I love it. Good advice to end on. Thank you so much for your time, your wisdom. And that was some really cool way to look at the insurance part of the business that you are kind of an expert in. So get in touch with Mark. He certainly knows what he's doing, and 1,500 clients don't lie. So Thanks for being on the Wealth Architect podcast, Mark. And those of you who are listening and watching, remember what I always say, never give up your power in your health, your wealth, or your time. See you next time. Have a great day, everybody.
You've been listening to the Wealth Architect podcast with Mark Yegge. Follow us on iTunes, Spotify, or wherever you get your podcasts. Like and subscribe on YouTube. Share and tell your friends. See you soon.